Okay, here's the boring bit. Anything you hear or see in this video is not investment advice. It could be absolute rubbish. Please do your own research. Hi there, I'm Justin Waite. I'm a small cap investor. Stock market investor. I invest in small companies because they have potential for high reward, but they're high risk. And you can see my channel here. I've done lots of videos before, generally on the companies I own and charts and stuff. But I've had people ask me, can you answer this or do a video on this? So I understand there's people, obviously, lots of people there at different points in their investment journey. So I thought, where should I start? What should I cover? So I'm going to do a series of videos, around about 10 minutes each. And they're going to start with the very basics of investing and work forward, okay? Now I'm going really back to the start. Now, if you think this series of videos will help you, by all means, hit that subscribe button below and also hit that notification bell. It's very important. If you want my video delivered to your inbox, okay, hit the notification bell. You'll only see the bell after you hit the subscribe button. Hope that makes sense. Okay, so first and foremost, let's go right back to the start, okay? Why should you invest in the stock market? Hang on a sec. Let's go back one further than that, okay? Why invest at all? So, one word answer here, apart from to get rich, of course. Inflation. Inflation is the rate at which prices for goods and services increase. The Bank of England's inflation target is 2%. They've got a target for this? So, why do we need inflation? You're probably thinking. Okay, a little bit of inflation helps stimulate the economy, okay? Because if prices go up, then you'll buy now before they get higher, okay? So it encourages you to buy. So producers produce stuff, manufacturers manufacture stuff, they employ people to do this, and the more they sell, the likely is that wages will get higher, of course. And so, of course, goods and services, wages are attached to that price as well. So a little bit of inflation is very good. It's also good for those who borrow money, because anyone with like a fixed rate mortgage should hope for a bit of inflation, because over time they are paying back their loans with less purchasing power. And of course, if house prices go up, faster than the rate of inflation, and you're paying off the mortgage is coming down, the price of your asset is building. All right, so a sense of wealth has happened there. So inflation is good, yeah. It's okay in moderation, but it's certainly better than deflation. Now, deflation is where prices go down. You're probably thinking, that's deflation, prices are going down. That's good. It is for like the everyday thing, petrol, gas, all that stuff, electricity. It'd probably be good if it went down. Okay, you're thinking? But if that deflation extended to like white goods or to cars or houses, that's a bad thing. People stop buying. So then manufacturers or producers or builders, start, say, cutting wages, laying off people, and the economy starts shrinking. And then this becomes a deflationary spiral, and people just stop buying again. This can be disastrous for the economy. This happened in the Depression in the 1920s, across the board, so prices went down by 10% or more. So you prefer a bit of inflation rather than deflation. The trouble is, I mentioned that the target for the Bank of England is 2%. Inflation is running faster than this. It's running higher than this. How much? According to the Office of National Statistics, prices in 2017 were 307% higher than an average prices throughout 1980. Over this period, the pound experienced an average annual inflation rate of 3.87%. It's pretty much close to 4%, So double what the Bank of England's target is. What does this mean? £1 in 1980 is equivalent in purchasing power of £4.8 in 2017, a difference of £3.8 over 37 years. Or, roughly speaking, if you hid 40 grand of cash in your mattress in 1980, it would only be worth 10 grand in 2017, or you could only buy 10 grand's worth of stuff, even though it was 30 grand's worth. So, essentially, unless your cash is earning more than 3.87% per year, you are losing money. So let's look at the ways you can increase your money, invest your money, save your money in some way. Okay, here's the most popular options: government bonds, bank saving accounts, property, and the stock market. Comment below. Let me know. Do you have, if you're watching this right now, I'd like to know, do you have savings? Where are they? I'd like to know, are you in the stock market? Are you investing in the stock market? Are you investing in property? Do you have your money anywhere? Let me know. Do you have your money across all of it, or where? Say none, or savings, or stock market, or property. Let me know, or all four. Just put a comment below, please. What are government bonds? So government borrow money, to build infrastructure, to do certain things, to build hospitals, whatever they do. Now, you can loan them money, and they will pay you an interest rate for that. You call it a yield, for the price of risking your capital, and it's quite a safe risk. Of course, the government. If the government goes through, they're all in trouble. But it's not a very good yield. Let's have a look at the moment, especially right now. So, 10-year bond government, they'd pay you 0.4, less than half of 1% over 10 years, every year over 10 years. A 25-year bond is less than 1%. It's 0.899. Okay? So if you imagine inflation is running at, say, 4%, a 25-year bond is paying you less than 1%. You're not making money with it. You're still losing money on your cash there. Although it's a very safe investment. Okay? Let's look at banks. If you have spare cash, you're probably saving in a bank. You're wasting your money. You're losing money there. If you've got your money in the bank, you're losing money. This is from Money Saving Expert. Top savings accounts, 1.5% for easy access. That's for an account you just get your money in and out of whenever you want. Or if you fix your money in there, 2.4%. And that's for you have to keep your money in there for 12 months or something. You can't just withdraw it. So it's not as liquid. Now, you heard a lot of people say, property, and buy a house, do it up, sell it on for profit, move on to the next one. Easy. Rent out maybe. It's quite easy. So how is property done, compared to shares? Let's have a look, shall we? Here are the investment options here, property versus shares. So Halifax Residential House Price Series. If you invested 100 grand in 1985, you'd get back £502,000 in 2014. A change there, 402%, or annualized 5.7%. Okay, so you are getting there, 2% pretty much a year. Look at equities. Equities are shares, another word for shares. If you invested 100 grand in 1985, 1.5 million, 1,433%, or 9.9% a year. Okay, pretty much 6% you're making on top of your money. Okay? And also, if you are still thinking, well, I'd prefer to do property, compared to property, the stock market is also more liquid. What does that mean? You can change your investment in cash a lot quicker. If you bought some shares this afternoon, you can sell them a minute later if they're a liquid stock. Why? Because with a house, for example, if you buy a house, you can't sell it straight away. You've got to have someone who wants to buy the house. That's not the same as shares. In shares, they have what's called market makers, middlemen, pretty much. If you've got 100 shares to sell, you don't have to wait for someone to come along who wants to buy 100 shares. You just sell them on the market maker, and they wait for someone to come along to buy 100 shares. So it's, very liquid. It requires less capital. You can invest, 100 quid, 50 quid in shares. If you're buying a property, you probably need a down payment in some way. So you have to save money. You need a lot of capital. You're putting that capital risk. It's also easy accessible. You can set up a shares account within minutes. Within an hour, you'd be online trading shares. And also, the stock market allows you to gain exposure to many different asset classes, including property. So why save up for a house when you can invest in property on the stock market? You're probably thinking, yeah, I know that, but shares, I don't understand the first thing about them. There's thousands of companies. You're right. There's 2,000 companies listed in London. And so they're all different sizes, all different sectors. They all get different kinds of terminology and metrics. It's very complicated. But I'm here to help. Okay? In the next video, I will show you how to get easy access to the stock market, get exposure to relatively low-risk assets with very little research, beat inflation with those investments, beat returns in the banks, and also avoid paying any tax on it. All legal. Now, if you're interested in seeing this next video, then please hit the subscribe button and the notification bell. Don't forget, you can see my face there. Sorry, there. Click my face, and there's also some videos there that also might help you. But there's more coming in this series. Hope that helped.